Many people lose money not because they bought junk stocks, but because they bought the so-called good company when everyone was watching it. Understand that, and you're finally at the doorstep of making serious money in the stock market. I'm Xiao Yu. Today, we're not looking at charts or talking about insider tips. I'm going to break down a high-profit formula that silences Wall Street and is often overlooked by both retail investors and professionals. Many people think making money means catching a limit-up move. Wrong. Big money relies on just four words: the Davis double play. This could be your closest step yet toward financial freedom. Don't blink. It's all substance. Let's work through a calculation many people get wrong. Say you buy a company whose earnings grow 20% a year. Do you think its stock should also rise 20% every year? If that's your investment logic, you're probably the person left holding the bag at the top. Why? Because you're only seeing one side of the coin: earnings or earnings per share. But you're ignoring the other side and the wildest one: valuation or the price to earnings ratio. What really doubles your money isn't linear earnings growth. It's the multiplier effect of earnings and valuation. That sounds abstract, so let me tell you a story. The main character is Shelby Davis, and remember, he wasn't some fund manager handling tens of billions. At first, he was just an ordinary employee, and even something of a late bloomer. At 38, he took $50,000 from his wife's private savings and entered the stock market. 47 years later, guess what that $50,000 became? 900 million. That's $900 million. How did he do it? Did he buy Nvidia or Tesla back then? No, he bought insurance stocks nobody wanted to look at. Back then, insurance was considered a sunset industry: boring, slow-growing, and unloved. What were insurance stocks trading at? 3 times earnings. 4 times. In other words, $3 bought you $1 of the company's earnings. Absurdly cheap. What did Davis discover? These companies looked unexciting, but their profits grew steadily by 10 or 15% a year. Not sexy at all, right? But then something amazing happened. As their results improved year after year, the market slowly started noticing them. People thought, wait, maybe this company isn't so bad. Its results are pretty stable. So money started flowing in. That's when the most profitable magic, the Davis double play, began. In the first stage, earnings rise. Say the company earned $1 per share, then a few years later it earns $2. That's an earnings doubling. The second stage, and the crucial one, is that people's opinion changes. At first, investors thought it was junk and gave it a 5 times earnings multiple. Now they see it as a blue chip winner and will pay 15 times. Let's do the math. At the start, $1 in earnings times 5 equals a $5 stock price. Few years later, $2 in earnings times 15 equals $30. See it? Earnings only doubled from 1 to 2, but the stock rose sixfold from 5 to 30. That's the multiplication. Your return equals the earnings growth multiple times the valuation expansion multiple. That's the essence of the Davis double play. Part of your profit comes from the company's hard-earned results. The bigger part comes from the market's excited valuation. But my friends, there's a huge trap here, and it's where retail investors most often get killed. The opposite of the Davis double play is called the Davis double kill. When does it usually happen? When you're most excited. Think about all those hot sectors at the start of 2021. Think of stocks trading at 50, 80, or even 100 times earnings. What was everyone saying then? Great sectors are worth paying up for. Earnings will grow into the valuation. Is that really true? Say you buy a company earning $1 per share. Because it's so popular, it trades at 50 times earnings, putting the stock at $50. If earnings still grow 20% that year, they rise to $1.20. Sounds good, right? But market sentiment changes. Maybe liquidity tightens. Maybe people decide the industry has hit its ceiling. They're no longer willing to pay 50 times earnings and think 25 times is reasonable. So what's the stock price now? $1.20 in earnings times 25 equals $30. See that? The company's earnings grew 20%, but your stock was nearly cut in half, falling from 50 to 30. That's the Davis double kill. Earnings keep rising, but you still lose your shirt because valuation contraction completely wipes out the earnings growth. So, Xiaoyu is telling you very seriously, the biggest investment risk is paying an extreme valuation for mediocre growth. So let's return to the practical question. In today's market, how do we find Davis double play opportunities? Does that mean buying low-priced, low-multiple junk stocks? Of course not. Sometimes a low valuation means the company is genuinely heading for bankruptcy. That's a value trap. To find a Davis double play, you need an eagle eye for misunderstood growth. Look for companies in their darkest hour, or a stage when nobody cares about them. The industry may have just gone through a brutal shakeout with competitors wiped out and everyone afraid to touch it. Nobody wants to look at the company. That's when its price-to-earnings ratio has been crushed to the floor, perhaps into the single digits. Second, and most importantly, its fundamentals are quietly changing. Maybe raw material prices have fallen, a new product has passed validation, or supply and demand in the industry have reversed. The change may not show up in the financial statements yet, or it may only be showing the first signs. Third, there must be a clear growth driver, not a story, but real growth you can actually calculate. Let's review a few classic A-share examples from recent years, and you'll see what I mean. Remember coal stocks a few years ago? They were the classic stocks nobody cared about. The whole world was pushing new energy, and everyone thought coal was obsolete with no future. Many coal leaders fell to price to earnings ratios of 3 or 4 with dividend yields as high as 10%, yet nobody bought them. But what was the logic behind that? Because nobody was optimistic, no one opened new coal mines, so capacity became locked in. But what about demand? As long as the economy keeps moving, electricity still has to be generated. Demand hadn't disappeared. So what happened? Supply and demand became mismatched, coal prices soared, and coal companies' earnings exploded. Earnings per share shot up. Then everyone realized, wow, this thing was a real cash machine. The cash flow was incredible. Institutions started piling in, redefining coal stocks from sunset industries as core high dividend assets. Their price to earnings ratios rose from 4 times to 8, even 10 times. Earnings tripled, valuations doubled, and the stock price rose 6 or 7-fold. That was a Davis double play happening right before our eyes. We saw the same script in past shipbuilding cycles and in highly cyclical chemical products. So if you want to catch a Davis double play, you have to be a lone hunter. Don't go where the crowd is roaring. When even market grandmothers are discussing a sector and every brokerage report is shouting strong buy, its valuation has already been fully priced in. If you enter then, you'll probably earn only the hard money from earnings growth while constantly fearing the scythe of a Davis double kill. You need to look in neglected corners for excellent companies. When these companies are unfairly punished by short-term bad news, such as higher raw material costs, exchange rate swings, or trouble in a non-core business, Xiao Yu wants to prepare you mentally. Waiting for a Davis double play is extremely painful. Why is it painful? Because before the double play happens, there's usually a long period of building a bottom. After you buy, the stock may go nowhere or even drift lower. You watch other sectors hit limit up after limit up and start wondering if you've lost your mind or simply got it wrong. At times like that, what supports you shouldn't be faith, but data and logic. Ask yourself repeatedly, has this company's profitability really been damaged, or is this just market sentiment at work? Is its valuation already near a historical low? If the worst happens, can the company survive? If the answer is yes, lie in wait like a crocodile, perfectly still, until the right moment to strike arrives. That moment often comes with an earnings report that beats expectations. When profits show year-on-year growth of 50 or even 100%, while the stock is still stuck at the bottom, a gap in market perception appears. The first sharp-eyed investors rush in and the stock starts to move. Analysts quickly raise their ratings from neutral to buy. Then mutual funds begin building positions and retail investors follow. That's when the wave of valuation recovery lifts you high. You realize that the small loss in your account can be completely recovered with just 2 big bullish candles. Everything after that is profit. But friends, the hardest part of a Davis double play isn't buying. It's selling. When do you sell? That's when human greed takes over. Your ugly duckling has finally become a swan. The media is praising it everywhere and giving it all kinds of impressive labels. When its price to earnings ratio has risen from 10 times to 40 or 50 times, remember Shelby Davis's lesson, leave at the climax. Earnings may still be growing, but the valuation spring has already been stretched to its limit. Any little change in the wind could trigger a valuation collapse. Don't try to earn the last penny. Leave the final stretch of the fish's tail to someone else and go find the next gem still struggling in the mud. Finally, Xiaoyu wants to share something from the heart. In financial markets, there are only 2 kinds of money you can make. One is money created by central bank liquidity, that's beta. The other is money made when the market is wrong, that's alpha. A Davis double play profits from the market correcting itself as it moves from extreme pessimism to extreme optimism. This is a contest of patience and understanding. You have to endure solitude, fight your instincts, stay greedy when everyone is panicking, and stay calm when everyone else is celebrating. I know it's difficult, but that's exactly why the rewards are so huge. Stop staring at daily gains and losses. They're just noise. Look through the industries lying on the floor. Find companies with single-digit price-to-earnings ratios and strong cash flow. Ask yourself whether their winter is almost over. Because spring always comes. And when it does, only those who planted their seeds early can harvest an entire forest. If you want to survive and thrive in this market, engrave the words Davis Double Play into your trading system. Don't be a chaser, buying high and panic selling low. Be the hunter waiting in the shadows. I'm Xiao Yu. If today's sharing gave you even a slightly new understanding of valuation and earnings, give yourself a quiet pat on the back. That means you've started looking at this brutal yet opportunity-filled market with an institutional mindset. Next time, we'll discuss how to use 3 hidden indicators in financial reports to predict an earnings breakout early. See you next time.